First cost assigned to the cost of goods sold. What does it mean? It means, sorry, oldest item assumed to be sold first. We'll see that. So what does it mean? We'll talk about this when we solve it. So again, the same example here. We have total number here 60 units and we sold 40. It means 20 units are here. Okay, so same example. So 40 units are sold, 20 units left as an inventory. So if we are using first in, first out, so 40 units sold, first in, so first we have these 10. So these 10 is going to be sold first. Left, how much? 30. And then this is the time for this item to be sold, 25. How many left? 5. And then times the 5 units from here needs to be sold. Order is fulfilled? Yes. So it means 40 units is going to be sold, 10 for 10 each, 25 for 14 each, and 5 for 18 each. So there is hierarchical order. Oldest cost. So you see, oldest cost gonna be sold first, right? So let me clear all this mess and let's see the solution here. You understand? Oldest cost is going to be sold first. So in order to complete 40 units order, 40 units order, first you sell the oldest from your inventory. Order is still there. You sell the other one. Order is still there. So from these 5 units at 18 each, it means these 5 units are coming from this 25 order, this 25 worth of cost in your inventory. So you know that. So now the 20 units that left, what they cost? $18. Right? We call this FIFO. First in the inventory that first come to our premises will be sold to the customer first. So it means we assign the cost first in, first come first serve basis, right? So this is how we calculate this. So 20 units left. What are the costs? Either 10, no. Either 14, no. Either 18, yes. 18 would be the cost of the ending inventory. So you see, when we average out, our values were different. We multiply this 20 with straight 15, that's it. We multiply this 40 units sold straight with 15. But now, you see, our first in, first out costing method, our ending inventory value is different. Our cost of goods sold is different. So let's compare first in, first off with the average method. So remember, ending inventory is 360 and cost of goods sold is 540. Ending inventory is 360 and cost of goods sold is 540. So do you see clear differences in the costing method? We switch from average to FIFO and look at that. We still have $20 in our store, yes. We still sold 40 units, yes, but the cost is different. When the cost is different, it means our profit is different, right? So we can say that the FIFO, why the FIFO cost is higher? Why the FIFO cost is higher? Because FIFO inventory cost is higher because the units in hand are recorded on latest prices. These 18 latest prices, current prices. So our balance sheet is according to current prices. So inventory is a part of balance sheet, right? So we can say that the balance sheet will be look like more up to date, more include more recent prices according to the inflation environment. What's going on? Our balance sheet looks like that. But our income statement is a little bit passive one, old one, because in calculating the profit, so this is cost of goods sold, right? So this figure will go to the income statement, and in average method it was 600. So look at that. Even in averages method, the cost of goods sold was 600, but in FIFO the cost of goods sold are even less than that. So when cost is lower, what is the profit? Sale minus cost is equal to profit. So when cost is lower, our profit will be higher, right? So if we use FIFO, we sold the same stuff, but we changed the costing method. What happened? We reduce our cost and our profit jumps up. Our profit increases, right? Or the real terminology is the profit is inflated. Inflated how? Because we use older prices. Older prices. We use older prices to calculate the costs. So that's why the FIFO, now the tagline is FIFO inventory resulted in latest prices. FIFO cost of goods sold profit is inflated. Why? Because its cost of goods sold contains older prices. First in, first out. First prices gonna be recorded or gonna be out in calculating profit, right? So cost of goods sold is even lower than average. Okay, let's talk about last in, first out. So you can just guess that what is last in, first out means. So if these are the inventories, the orders are coming, and this is your factory stack, and this is the customer. So these are coming to your factory. So last in, first out means if customer place the order, last in. So the latest inventory that comes to your business will be sold first, and then the rest of the things going to be sold. It's the opposite of first in, first out. So you can just guess where we are going. Last in, first out. Last in, the last night, some orders, I purchased some stuff, will come to my shop, and this stuff I'm going to be selling first, and then the older one. Right? So, costing is opposite to FIFO, of course. Last cost into the inventory go to the cost of goods sold. Oldest in inventory, oldest cost are in inventory. So we just like in FIFO we talked about later, and in LIFO we'll talk about this later when we solve the illustration. Let me talk about that. What's this mean? So the same question, we sold 40 units, 20 left here. Now, last in, first out. We sold 40. So last in, last order was 25. So 25 multiplied by 18. How many left? 15. So 15 multiplied by 14. So this is how our 40 total sold units are done, and 20 units are left. It means 10 is coming from this order 14, and 10 is coming from this order 10. So let's see a very nice solution, because my writing here is not pretty good. Right, guys? Here we go. You see some differences here? Wow, our cost of goods sold shoots up. Even from average was 600 and now it's 660. When a cost is too much high, look at the formula for profit. Profit goes down. When profit goes down, it means we have to pay less taxes, right? So because in LIFO, the cost of goods sold contain latest prices, right? Latest prices. So in that way, the ending inventory that is on the balance sheet contains older prices. See, older prices. So we can say that the balance sheet, because this ending inventory will go to balance sheet. So we can say that our balance sheet is not up to date. Our balance sheet contains older prices, right? It is not inflation adjusted, which means the effect of inflation is not there in this balance sheet. But our income statement is up to date, well, right? According to latest prices, and that's it. But the drawback is it will show lesser profit. When it shows lesser profit, it means taxation in dollar terms is going to be also lower, right? So before going into this illustration, we would be having a break. But before going to the break, let me ask personally whether you understand these or not. So Florian, you understand the
Yes, I
specific,
did.
specific unit costing? We are not going, because every project is different, every item is different, so we don't need costing. We need costing method for three: average, LIFO, FIFO, right? And if you understand the logic, it is very easy for you. If you don't
Yes,
understand the logic, then you will be confused. Okay, then you will be like, having a guesswork. Okay, LIFO, balance sheet is up to date, no, up to date or not. I gave you the logic here. Why it is the LIFO income statement is up to date, because it contains latest prices, right? Why the FIFO, income statement is not up to date, because FIFO income statement contains older cost for cost of goods sold and profit is higher, but its balance sheet is very up to date, right? So these are some, and we talk about pros and cons after this. Yeah, we will talk about the pros and cons, why, what are the benefits and what are the drawbacks. Although I already gave you some, that okay, profit will be higher, profit will be lower, taxation will be higher, and taxation will be lower. Okay, so let's just talk about the rest of the stuff after the break. Let's have 10 minutes break. Okay, class. So welcome back to the break.